Today, I want to help you understand when will real estate interest rates drop. One of the biggest questions I get asked today in today's real estate market and economy, when will real estate interest rates drop? Well, by the end of this video, I'm going to help you be able to look at signs that might tell you when real estate interest rates are going to drop and how you can take advantage of that as a real estate investor. Are you somebody, or do you know somebody that is absolutely sitting on the sideline waiting for real estate interest rates to drop? Are you worried that real estate investing might not work as well when interest rates are higher than they have been in the past? Well, stick with me as I dive into these conversations by first explaining what interest rates are in real estate. Next, I'm going to talk about how real estate interest rates can affect investors. And finally, talk about the signs you can look towards to understand when real estate interest rates might be coming down. If you're ready, let's go. In real estate, an interest rate is a percentage that a borrower pays to a lender in order to purchase a piece of property. Essentially, it's the price for taking out a mortgage, and it directly impacts the payment that an investor or homeowner is going to pay every single month. Depending on how high that interest rate or how low it is, it's going to significantly impact the amount of that payment. A higher interest rate obviously means a higher monthly payment. A lower interest rate obviously means a lower monthly payment. Here are some important points when it comes to interest rates. Obviously, interest rates affect affordability, right? If you're somebody looking to buy a home and you have a budget that you could spend maybe $3,000 a month, 3.5 years ago, you could have bought a home that was worth $500,000 or $600,000. Today, that's not the case. With interest rates being almost double, sometimes triple of what they used to be, you might look at a home that might be affordable and say maybe the $300,000 range or less, because that interest rate directly affects affordability. A lot of times people need to understand that interest rates are affected by market conditions. So inflation plays a big role in this. Many times the Fed will try to stimulate the economy by lowering interest rates or slow the economy by raising interest rates. Another factor that's included when you look at interest rate is the overall buyer or purchaser. What is their credit score? Are they a great candidate to pay this money back, or do they have a credit history that doesn't look so good? That will also affect the rate in which somebody will borrow money to you. And there's two types of interest rates, fixed interest rate and a variable interest rate. A fixed interest rate will stay the exact same throughout the term of the loan, whereas a variable will go up and down depending on market conditions. So if you're in the current economy and you think real estate interest rates are going to go down and you did a variable, as it goes down, that will be adjusted as well. But there's a lot of people that opted to get a variable interest rate maybe 3.5, 4 years ago, and interest rates are now up and their payment is much larger than it used to be. So when you take out a loan, an interest rate is calculated into that mortgage payment. An interesting thing when it does come to mortgages and interest that is paid, typically mortgages are front loaded. So let's say you buy a home that's $300,000, right? Over the course of a 30-year loan, you are probably going to pay about $675,000, $700,000 for that home. If interest rates are higher, you're even going to pay more than that. In interest alone, you're going to pay hundreds of thousands of dollars or more than you paid for the original purchase of the home. If the original purchase home was $300,000, you might pay $350,000 to $400,000 in just interest. The other thing to note with interest rates is that interest is front loaded on a loan, right? So when a bank loans you $300,000 to buy a home, you're paying it off over a 30-year period of time. Typically, that monthly payment, say that the monthly payment is $2,000, just to make math easy, probably $1,800 of that first month's payment is going towards interest. $200 might be going to principal pay down. Now, that's not exact, but that's a rough sum. But the longer you pay your mortgage payment, eventually more of that money every single month goes towards principal pay down and less towards interest. But they do this for a specific reason, because if you refinance your home in 5 years, 6 years, 7 years from now, again, you've been paying most of that money to the interest rate and very little towards principal pay down. So that $300,000 home, maybe 5, 6, 7 years from now, you might owe $285,000 on that home versus what you think you might owe, maybe $250,000, because most of the monthly payment is going to pay interest on the loan versus principal pay down. Because at the end of the loan, say year 29, you're probably paying $200 or $100 toward interest and $1,800 to $1,900 towards principal pay down. So how do interest rates affect the economy? Well, for a couple of different ways. Number one, if interest rates are high, it typically slows people from wanting to buy homes, right? Because they are waiting for interest rates to go down. When interest rates are high, they can't afford as much of a home and their monthly payment goes up, which means that they can't spend money on other things that they might need, or even on discretionary things that they want, like vacations or gifts or whatever it might be. Their ability to spend goes significantly down when interest rates are high. And because of that, people are a bit more cautious to buy homes. Now, you would think with that, demand is going down, prices will go down. And that's typically true. However, if inventory is also low, meaning there's not a lot of homes on the market to buy, that means that prices are going up, right? So we're in an interesting situation in today's economy where the demand isn't super high to buy homes, but the inventory is extremely low, and so prices are remaining fairly high. So if you were to look today, what is the current interest rate on December 18th, 2024? Currently, a 30-year fixed mortgage is about 6.5%. A 15-year fixed mortgage is about 5.85. If you contrast that to what it was 3.5 years ago, you will realize that your monthly payment 3.5 years ago was probably half of what it would be today if you were to purchase a home at today's current interest rate. So are there signs saying that interest rates are going to go down? What can you look for as an investor or as a homeowner to understand if interest rates are going to go down? Number one is watching the Federal Reserve policy. When the Fed indicates plans to lower the interest rate, that is probably the best indicator that the interest rates are going to go down. And they do that to combat rising prices. The other thing to look at is inflation. If inflation starts to fall significantly, the Fed might feel less pressure to keep interest rates high. Another indicator is an economic slowdown. If you start to know when the economy starts to slow down, stuff like declining GDP growth or high unemployment rates, the Fed can also go in to try to stimulate the economy. So that is also something to look for that could be a sign that interest rates might come down. Another thing to look at is housing market trends. A housing market surplus with less people demanding to get into it means that the Fed eventually might have to lower interest rates to meet the demand of people wanting to get these surplus in homes, meaning that they feel like they can afford it because interest rates are lower. Now, interest rate affects real estate investors and homeowners like crazy, but what if there was a real estate investment strategy that did not matter what the interest rate was? Are there such strategies that exist? I'll tell you, there absolutely is. I've come up with one over the last 12 months. I think I'm the one who came up with it. I haven't seen anybody else doing it, but it's something that I call cash flow flipping. And it works in any economy. It doesn't matter what the interest rate is. And it's something that anybody can do regardless of market conditions or what's happening. And I've got the full video to explain exactly how to do this strategy. Click on this video below, cash flow flipping, and you'll understand step by step how to do this strategy to create not only cash flow every month, but create massive wealth. Thanks for stopping by. Have an amazing day.